Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. 3 drivers behind the semiconductor sell-off and market outlook. This video presents a direct informational narration of the source document.
Our analytical framework covers 3 main pillars driving the market right now. First, the impact of non-farm payrolls. Second, AI capital expenditures. And third, the SpaceX IPO rotation. We're also going to examine specific South Korean contagion risks and wrap up with precise technical levels to watch.
Section 1. The Semiconductor Sell-Off.
To start, the source text highlights a broad and severe market liquidation. The Nasdaq fell nearly 5%, while the broader technology sector dropped by 6%. The semiconductor index took the hardest hit, plunging 10%, with all 30 of its component stocks falling.
Looking closely at the liquidation, we see varying degrees of severity. Stocks like Marvell and Micron experienced deep retracements of 12 to 16%. Meanwhile, ASML, TSMC, and NVIDIA saw slightly smaller drops, ranging from 4% to 6%. The source notes that this sharp profit retracement really serves as a structural warning for anyone holding positions at lower entry points.
Section 2. Driver 1. Non-farm payrolls.
This represents the macroeconomic shock from the latest employment data, and the magnitude of the beat was significant. May non-farm payrolls came in with an increase of 172.2K jobs, blowing past the expectation of just 85K. On top of that, April was revised upward from 115K to 179K, and March from 115K to 214K. That represents a massive net upward revision of 93K jobs over just the 2 preceding months.
Breaking down that granular labor data reveals some robust sector growth. The overall unemployment rate actually remained unchanged at 4.3%, and the labor participation rate held steady at 61.8%. Looking at specific sectors, private sector employment jumped by 120K, government jobs increased by 52K, and manufacturing saw a modest gain of 7K. The leisure and hospitality sector also stood out, adding 70K jobs, which is well above its 12-month average.
Because of this strong employment report, market expectations have firmly shifted toward a higher-for-longer monetary policy. Prior to this data, the market had only partially priced in rate increases. Now, following the release, a 25 basis point rate hike by the end of 2026 is fully priced in. The source document points out that this shift directly impacts valuation models, particularly through the lens of long-term bond yields and discounted cash flow models.
Section 3. Driver 2. AI capital expenditures.
Here we examine the capital allocation risks surrounding massive investments by mega-cap technology firms. We're seeing a structural shift in how mega-cap tech is financing its ambitions. Historically, the Big Four relied heavily on debt financing. The current AI race, however, is incredibly capital-intensive, prompting a swift shift toward equity dilution. Meta is exploring a $10 billion stock issuance, while Google has initiated a record $85 billion issuance. Since existing debt leverage is already quite high, these companies are moving away from historical debt norms and leaning into equity dilution to fund their AI infrastructure builds.
The source material outlines 2 potential outcomes for this massive spending. The revolution scenario assumes these investments successfully drive revenue acceleration, validating the high-input, high-return model. On the flip side, the bubble burst scenario assumes that failed monetization leads to massive cash destruction. The document stresses that the high growth of the entire hardware supply chain completely depends on the capital expenditures of these 4 major tech companies. If they fail to monetize AI, those negative effects will punish the entire supply chain.
Looking at specific equities, Meta has been in a sideways consolidation. The document suggests that building a position near the 500 level provides a necessary margin of safety. Microsoft, on the other hand, is highlighted as a prime holding. Structurally, Microsoft is positioned closest to realizing successful AI monetization, and its free cash flow is projected to recover the fastest among the megacaps once that monetization is validated.
Section 4. Driver 3. SpaceX IPO rotation.
This driver represents idiosyncratic capital rotation based on private market speculations. Right now, speculative capital is actively rotating out of highly appreciated, profitable tech equities. It's moving to prepare for the upcoming SpaceX IPO, which is priced at a fixed $135 per share. Because the initial float of shares is expected to be very low, it creates an environment ripe for volatility and intense speculation, naturally drawing capital away from the broader market.
Section 5. South Korean Leverage Risks.
This details specific international contagion risks highlighted in the source material. There's a severe vulnerability in the South Korean market defined by a three-step process. First, retail investor leverage is currently sitting at record highs. Second, these highly leveraged portfolios are heavily concentrated in just two major memory chip stocks, Samsung and SK Hynix. And third, this creates an intense margin call risk if the broader semiconductor sell-off hits these specific equities.
To put that risk into perspective, market-wide circuit breaker thresholds in Korea are triggered at index drops of 8%, 15%, and 20%. The source notes that U.S. memory peers like Micron and Western Digital have already dropped 13% and 11%. If Samsung and SK Hynix follow that same trajectory, it could easily trigger a level 1 8% circuit breaker, leading to a cascade of forced liquidations.
Section 6. Technical support levels. Now we'll outline the precise technical boundaries for major indexes and individual equities as defined by the source document. Within the semiconductor sector, there's a notable divergence between two major ETFs. The SOXX ETF is currently holding its steep upward trend line, with critical support identified in the 489 to 532 zone. Conversely, the SMH ETF, due to its different component weightings, has already technically broken down. The source suggests closely watching if SOX gaps down to confirm the breakdown we're already seeing in SMH. Mapping out the potential sequence of a pullback in the broader market, the S&P 500 is showing structural downside risk. From current levels, a drop down to 7232 serves as a critical CTA sell trigger point, which could introduce programmatic selling pressure. Below that, the extreme, yet structurally reasonable correction limit for this current upward phase lies between the 6,800 and 7,000 zone. That aligns with roughly a 10% retracement toward the 200-day moving average.
For the NASDAQ, the technical parameters are naturally wider due to its inherently higher volatility. The source identifies the extreme technical correction limit for the NASDAQ to be in the 6230 to 6370 zone, which is again near its 200-day moving average. A drop to this level would represent approximately a 17% decline from its peak, which the document classifies as a structural correction rather than the onset of a true bear market.
Looking at technical breakdown levels for individual tickers, Tesla's upward trend is officially broken, with downside limits pointing toward 368. NVIDIA is facing resistance at 203, with the downside potential to 175. Marvell's nearest technical support rests at 210. Finally, Broadcom has reached its initial 370 to 385 zone, with stronger structural support waiting between 324 and 365.
With macroeconomic shocks from labor data, massive capital requirements for AI, speculative rotation into private markets, and international leverage risks all colliding at once, the central question remains: will these technical support lines hold through the upcoming volatility, or will these combined pressures trigger the wider structural downside limits we've outlined today?